With the recent decline in stock prices, we are seeing more and more dividend traps. In this video, I'm going to show you how to save thousands and thousands of dollars in investing mistakes by avoiding dividend traps. I'm going to show you how to figure out when you're looking at a dividend trap and how to avoid it. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. Follow along as Jack and Jill navigate their way through the world of dividend investing. Before we get into dividend traps, we need to cover two things: dividend yield and payout ratio. So what is the dividend yield? It's simply the dividend, the annual dividend, divided by the share price. So for example, if a company is paying out a dividend of $1 per share, and the share price is $20, and you buy the shares today at $20 a piece, we take 1 over 20, we express that as a percentage, and you can see that the dividend yield in this example is 5%. So now let's say Jill wants to invest $20,000 in this company, and the share price is $20 a share. She's going to be able to buy 1,000 shares. And if we take the 1,000 shares, multiply that by the $1 dividend per share, you can see that she will earn $1,000 every year for as long as she owns these shares and as long as the company continues to pay the dividend. So another way to look at it is now we're going to take the dividend yield to help us figure out very quickly what is the return on her investment. So again, in this example, she's looking to invest $20,000 in this company. You can see that the dividend yield is 5%. So what's 5% of $20,000? That's $1,000. And so we end up with the same number at the end of the day. So like I said before, in this example, Jill will earn $1,000 every year in dividends as long as the company continues to pay the dividend and as long as she continues to own those shares. Now, remember, this dividend yield is based on your stock purchase price. So in the case of Jill, she's buying the stock today at $20. Her purchase price is $20. The dividend that the company is offering is $1, so the dividend is going to be 5%. Now, the share price can go up to $30 tomorrow. It can go down to $10 tomorrow. Doesn't matter. As long as Jill owns the same number of shares, she will make a 5% return on her investment as long as, in this example, the company continues to pay the dividend of $1. Now, I've just mentioned this before, I'll say it again. The dividends are earned regardless of stock price changes. So the stock price can go up and down after you've bought it, but the dividends are yours to keep. And in this example, it'll be a 5% return on investment. So that's exactly what a dividend yield is. It is the return on your investment while you hold on to your shares. And the dividends are deposited as cash directly into your trading account. So you can spend the dividends if you wish, or you can reinvest them. Now, let's take a look at the payout ratio, because this is going to be very important, and this is going to help us further along in looking at dividend traps. So what is the payout ratio? Very simply, it's the dividend, again, annual dividend, divided by the earnings per share. Earnings are profits. How much money is the company making per share? So let's take a look at two real-life examples. Jill is interested in investing in MetLife. Jack is interested in investing in Allstate. So they're going to take a look at the payout ratio for both of these companies. So let's start with Jill. She's going to go to any website. In this example, I'm using Yahoo Finance. Any website that gives you stock prices. And so Jill is going to look at the earnings per share, which is $3.95. And she can see that this company, MetLife, is paying a dividend at the time of this recording. The company is paying a dividend of $2. This is the annual dividend. So remember the formula for payout ratio. We take the dividend, which is $2, divide it by $3.95, which is the earnings, express that as a percentage, and we can see it's 51%. So what does this mean? It means the company is taking 51% of what it earned, and it's paying that money to the shareholders. The rest of the money the company is keeping, reinvesting it back into the business to grow the business. So this is a good payout ratio. Let's take a look at Jack. He's looking at Allstate. He's going to do the same thing. He's going to go to Yahoo Finance. He's going to see earnings per share, and he's going to see the dividend for this company. So if we put that into the formula, you can see that the company earned $3.08, but it paid a dividend of $3.40. So that is a payout ratio of 110%. So you might be wondering, where are they coming up with the money to pay the shareholders? Because it doesn't look like they have enough earnings to cover the dividend. So sometimes this is a temporary situation. The company is able to grow its earnings before the end of the year. So that's fine. In some cases, companies are going to be borrowing money to pay the shareholder. And we don't want that because that's going to increase the debt of the company. So when we see a payout ratio this high, another possibility here is that the company may have to reduce its dividend. And as dividend investors, we don't want that, right? We are relying on the dividend income coming in every year. And hopefully that dividend income is growing every year, not going down. So if there's a possibility the company is going to reduce its dividend, we want to stay away from that company. So if we take a look at both of these companies, MetLife and Allstate, assuming all things considered equal, assuming they're all undervalued, the debt level is fine, the earnings are good, MetLife would be a better investment because the payout ratio is less. And there's a possibility for MetLife to increase its dividend next year because the payout ratio is pretty good. Allstate may not be able to, well, at this case, when we're looking at the numbers, very unlikely they're going to increase the dividend. More likely is that they will reduce the dividend. So I showed you how to do that. You can go to Yahoo Finance or any website and get the earnings and the dividends for any company you're looking at investing in. Faster way to do it is on the Simply Investing platform. We calculate the payout ratio for you, or our application does calculate the payout ratio for you for all 8,000 stocks in the US and Canada every single day. And we show them to you on the screen. And so it's very easy for you to filter out companies that have very high payout ratios. So now let's take a look at what is a dividend trap. So the best way for me to explain what a dividend trap is just to show you what a dividend trap looks like. So now on the screen, you can see there's 7 companies here, sample companies. We have company A, company B, C, D, E, F, G. The dividend yield for company A is 2.1%. Dividend yield for company B is 1.8%. Company C, 1.9%. Company D, 38%. Company E, 1.7. Company F is 2.2. Company G is 1.8. Now, do you notice anything odd about any company on the list? Now, if you're watching it, you can see all of the numbers on the screen. If you're listening, I've just gone through all of them. Did you notice anything odd, anything strange when you look at the dividend yield? There's 7 companies on this page. 6 of them have a dividend yield in the range of 1.7 to 2.2. Right? That's it. They're between 1.7% to 2.2%. That's the dividend yield. The oddball here is company D. 38% dividend yield. Now, you might think this is an exaggeration. There's companies out there today that have dividend yields of 18, 20, 30%. So now Jack is thinking, his first reaction is, you know what? I'm going to invest all of my money into company D. Why bother making 2% return every year when I can make a 38% return every year? And my answer to Jack and to anyone else who's thinking about this is don't do it. And we're going to see in a couple of minutes why you don't want to invest in this type of company. So just looking at the list of 7 companies, company D is a potential dividend trap, and it requires a little bit more investigation. So why is the dividend yield so high? Every other company, it's around 2%. And then this company's sitting up there at 38%. So why is the dividend yield so high? There's two reasons for this. And we're going to talk about both of them. Reason number one, the dividend share that the company is offering could be very high. You could have a company that's giving a very high dividend, and so the yield is going to be high. On the other hand, the stock prices drop so considerably, the stock is out of favor. And when the stock price drops, the yield is going to go up. So now let's take a look at both of these reasons. We're going to start with the first reason. Okay, we're going to give the company the benefit of the doubt. Okay, they might be giving a very big dividend. So let's take a look at this example. Let's say this company is giving a dividend of $1 per share, and the share price is $4.50. So if you do the quick math here, you can see that the dividend yield is 22%. This is an incredible dividend yield, very high. This is much higher than what you're going to get in a bank account, a term deposit, or even a bond. So a 22% yield is extremely attractive to investors. And what normally happens, and we're assuming this is a quality company, the debt is very low, the company is well managed, the company has a history of profitability, has a history of growing its dividend, right? So all of these things, I'm assuming all these things are true, that this is a quality company. So what happens is investors are not dumb. They're going to see the yield, they're going to look at all the other numbers, and they're going to realize, well, this is a great investment. I can make a 22% return on this investment. So what happens is, as investors rush in to buy shares in this company, the demand for the shares goes up. And as demand for the shares go up, the share price is going to go up. So watch what happens when the share price goes to $10. Now my yield is only 10%, right? The dividend hasn't changed. The company doesn't change the dividend every single day. The dividend is set. This is set for the entire year. It's an annual dividend. Share prices go up and down all the time. So now as more investors rush in, because even 10% is a good deal, the demand for the shares goes up, the share price goes up to $20 a share. Now the yield is 5%. And finally, let's say the share price settles at $30 a share. So I take the annual dividend of $1 divided by the share price, which is now 30. You can see that my yield is 3%. And now we're back down to earth, with most companies ranging on average 2.5% to 3% dividend yield. So this is what normally happens when the dividend is very high and it's a good quality company. The share price is going to go up and the yield is going to come back down to earth. Okay, this is what we typically see. I've been doing this for 22 years. I've been a dividend investor for over 22 years, and I've seen this many, many times over. Now, let's take a look at the second reason. And this is the one that should concern all of us. And this is where the stock price has dropped considerably. So why would a stock price keep going down for any given stock? Why? And so there's a number of reasons, right? There could be news about company fraud, like we saw with Enron and other companies throughout history. Companies can run into financial trouble that they can't get out of. Legal issues. Companies could be consistently losing money. Expenses are too high. They're just not profitable anymore. So any number of these things, and then negative news about the company, and then in social media, things just get blown out of proportion. Any number of these reasons, negative reasons, will put the stock out of favor. So this is the opposite of what I showed you before. So instead of investors rushing in to buy the stock, investors are selling their shares in the company. They don't want to have anything to do with it. And as investors start to sell their shares, demand for those shares goes down. And so then the stock price starts to go down. So let's see what that looks like. So let's say in this example, we're starting with, again, a annual dividend of $1. Share price is 25. So 1 over 25, that's a 4% dividend yield. Again, nothing too crazy, 4% yield. Now, as investors start to sell their shares in the company, nobody wants to buy the shares in this company. Demand for the shares go down. As demand comes down, the stock price is going to come down. Now watch what happens if the stock price drops to $10. Now my yield is 10%. Again, my dividend hasn't changed. Like I said before, dividends don't change day in and day out. They're set, fixed by the company. The share price goes up and down all the time. So now in this example, let's say more investors are selling their shares. Nobody's interested in buying stock in this company. Demand for this company's stock continues to go down. As that happens, the share price tanks, and now the share price goes down to $5 and then to $2. Now, this is just an example, but I want to highlight what's happening to the numbers here. So the dividend is $1. The share price is now $2. That's a 50% dividend yield. Very high. As you can see in this example, right, the share price has come down. As the share price remains down, because nobody wants to touch the stock at all, the dividend yield is going to stay high. Okay, this is very different from the first example, because if this was a good company, people would be rushing in to buy the stock price would come up, the yield would come down. In this example, the yield has been at 50%. I don't know. This example, let's just say for the last 3 months, it's stuck at 50%. That has to tell you something, that even with the high dividend yield, investors are staying away. Do they know something we don't know? We don't want to take that risk. So when you come across a very high dividend yield, and it's been high for a while, even a couple of weeks, and it's been high for a while, this is telling you that investors are staying away from this company, right? So the risk to your investment is going to be very high, right? So this is a red flag anytime you see a dividend yield so high. What are the risks of investing in dividend traps? Because some people might say, well, I'll take that risk. It's a 40% yield. Even if the company cuts the yield in half, I'm still fine. But let's look at the risks first. Most likely, the dividend will get reduced or eliminated. We see this time and time again. And when a dividend is reduced or eliminated, the stock price goes down even further, because that just drives investors completely away. So now, if you eliminate the dividend, your yield is now 0%. Why would you put your money at risk in a stock at 0% when you can put it in a bank account, a term deposit? At least the money's guaranteed by the bank or the government in case of a government bond, and you could make something higher than 0%. So this causes a further decline in the price when the dividend is reduced or eliminated. In other words, the high payout ratio is not sustainable, like we saw in the example with Allstate, where the payout ratio is over 100%. And obviously, the yield is going to come down if the dividend is reduced. Now, if there's serious trouble in the company, and again, a consistent low stock price, high yield, tells me that there's something wrong, then we could see further declines in the stock price as well. And as an investor, you don't want to invest in something that the stock price is going to be coming down. Now, I want to share with you very quickly a personal story of mine. I'm not proud of this story, but I'm hoping that this lesson learned I can impart on you so you won't make the same mistake like I did. So in 2007, early 2008, Washington Mutual, this was a big bank in the US, had been around since the 1800s. Stock price came down. The dividend yield was at 10%. Now, I didn't follow my own rules of investing. I got greedy. Double-digit returns. That was amazing. I justified it to myself, same as what I said before. Hey, if they drop the dividend, if they cut the dividend in half, I'm still going to make 5%. So 10% is really good. I don't remember how much I invested at the time. I'd have to look it up. Maybe it was around $4,000, $5,000 at the time in Washington Mutual. I think it was 12 to 14 months after I had purchased it, maybe even less than 12 months, the company went bankrupt and the shares were down to zero. The entire investment of $5,000 was lost. So what I want to share with you here are my words of wisdom when it comes to dividend traps. If the dividend yield is too good to be true, it probably is. So please do not chase high, very high dividend yields, you're going to be putting your money at great risk. So how can you avoid these dividend traps? And this is what Jack and Jill also want to know in their journey of dividend investing. How can they avoid making the similar mistakes I've talked about? And how do you avoid getting sucked into a dividend trap? So here's a couple of things. Make sure the payout ratio is 75% or less. Avoid any company with a high dividend yield. And the way to do that is to compare the dividend yield to other companies in the same industry. So if the entire industry is at around 2%, 3%, and you're looking at a yield of 18%, that should tell you something, right? So you want to avoid companies if the yield is too high. So remember, again, words of wisdom. If the dividend yield is too good to be true, it probably is. So does this mean that Jack and Jill can now go out and buy any stock that has a low payout ratio and a reasonable dividend? Can they just go ahead and start doing that today? And the answer is no. There's a couple of other things we want to look at. We want to look at not just dividend stocks, but quality stocks. So don't put your money in any stock that pays reasonable dividends and the yield is reasonable. We want to make sure it's a quality stock. We also want to make sure the stock is priced low. Anybody who's interested in learning more about how to figure out when a stock is priced low, please go check out episode 1. I explain very quickly how to figure out when a stock is undervalued and when a stock is overvalued. So you can figure that out very quickly. So how do you know when you're looking at a stock if it's a quality stock and it's undervalued? How do you know both of those things are true? So to help you with that, I've created what I call the 12 rules of simply investing. This is your checklist. You want to make sure a company or a stock passes all of the 12 rules before you invest in it. If there's even one failure, skip it. Move on to another stock. So we want to make sure that a company, you're looking at a quality company and it's undervalued. The 12 rules here are designed to help you minimize your risk, designed to help you avoid dividend traps, and to maximize your returns. For those of you watching, you can see the 12 rules on the screen. For those of you on the audio version, I'll just kind of quickly go through them here. Rule number 1, do you understand how the company is making money? If you don't, skip it, move on to another stock. Rule number 2, 20 years from now, will people still need its products and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession-proof? Rule number 5, is it profitable? Rule number 6, does it grow its dividend? Rule number 7, can it afford to pay the dividend? And that's where we looked at the payout ratio, so 75% or less. Rule number 8, is the debt 70% or less? Rule number 9, we want to avoid any company with recent dividend cuts. Rule number 10, does it buy back its own shares? Rule number 11, is the stock priced low? Is it undervalued? Right, that's important. And rule number 12, keep your emotions out of investing. For anybody that's interested, the Simply Investing course, I cover the 12 rules in the course. It's about 2.5 to 3 hours to go through the entire course. It's online. You can take your time, go at your own pace. I also show you real life examples as we apply the 12 rules. I also provide you with a spreadsheet. Very simple. You can go in there, plug in all the numbers, and you can figure out if you're looking at a quality company and if it's undervalued. The Simply Investing platform does the work for you. So in the platform, which is a web app, we apply the rules to all 8,000 stocks in the US and in Canada every single day. So you can see immediately whether it's a quality company and whether it's undervalued. We also show you companies that are overvalued, so you know what to avoid for now. So the platform makes it a lot easier to filter out through all the companies that are out there. I want to thank you for watching, listening to today's episode. Make sure you hit the subscribe button, hit the like button as well. For more information, take a look at our website, simplyinvesting.com. And remember, we have a new episode out every week, and I will see you next time.